Bitcoin crashed on Friday, a $20,000 spread candle from the top to the bottom on some exchanges. $19 billion were liquidated from crypto markets across the board, about 12 times the largest liquidations we've had in the past, including the COVID crash and FTX. We're going to dig into the macro circumstances that may have had an impact on that, and also the actual mechanics of this liquidation. This is going to be a massive show. James is not here today. We are honored to have the author of The Big Print, Lawrence Lepard, here with Mike, Dave, and myself. Let's go.
Let's go.
Good morning, everybody, and welcome to Macro Monday as markets attempt to allow the dust to settle of what happened on Friday specifically and over the weekend. I don't even know where to start. I'm going to just bring on Larry, Mike, and Dave. Welcome, gentlemen. We'll start where we always start, Mike. Tell us how Bloomberg's viewing what happened over the weekend, and then we'll dig, obviously, into the crypto side of it. Just massive liquidation event.
One of our top economists, Estelle, pointed out that China tariffs and AI are the key things to really think about for next year. She pointed out they're looking at alternative data, their price trackers showing renewed deflationary impulses, price cuts, cash-strapped consumers, hotel and leisure, which gives a green light for the Fed to cut rates. So on their alternative tracker is likely to give the Fed, green light for easing. She thinks retail sales will probably be okay, but lower rates might start to help. So not much difference from her. Ira Jersey, our chief rate strategist, point out the next important level for the 10-year support remains 4%, but the next is 3.86. 2s, 10s, he's still in that steepener. Just for our audience, no, steepener means when short-term rates usually drop more than long rates. Widen that spread. 2s, 10s have been stuck and can't seem to get above 60 basis points. He thinks it's eventually going to 100, just a matter of time. And right now, he pointed out the 2-note yield right now is priced for about 3 cuts into March. And then our Jillian Wolf, equity strategist, point out some of the excesses in equities, but she actually rarely tilted over to gold. Pointed out it's been a key driver of earnings, most notably in Canada. And it's mostly going up on weaker fears. I figured that would tip you off there, Lawrence. Yeah. And then I focused on I focused on gold and metals, and just an FYI, Bloomberg TV radio has asked me to comment on the silver rally today after our show, and usually that's a sign of a peak. Just want to let you know, and not to mention the key thing I've been focusing on is this gold silver ratio. It's dropped below 80. 80's been a good support. I view that as a level to be testing that support. Right now it's 78 basically 79, and a key indication for that is stock market volatility in the U.S. is just buried. 90-day volatility was last week bottomed 8.6. Now it's a 0.10. I point on the VIX volatility index. The 200-day moving average is basically a bull flag, and we're above that level now, about 19. And so, my indications are this is just getting started. Gold's really expensive. Crude oil's just getting hammered, and those signs are clearly global recessionary. And the copper is a key thing I'm focused on. This is the next big move. It's at 5. Can it go to 6 or drop to 4? And I think the risks are it follows iron ore, bond yields in China, and crude oil, and heads towards 4. Back to you.
So quickly, before we go into the liquidation event, because I know you're dying to do it. I do want to show, because Mike talked about metals. This is the silver chart, obviously making a new all-time high. Absolutely skyrocketing right now, over $51. This looks like an illiquid altcoin chart in 2018. Larry, there's some wild things going on in silver. I know that you wanted to discuss, so let's knock that out before we move on to the crypto markets.
Okay, just quickly. I retweeted this morning. There was Bloomberg had a story, Mike, I'm sure you saw it, where they said that there's a squeeze going on in silver in London.
Yeah.
And people were checking out how to ship 15 to 30 million ounces from the New York COMEX stocks to the London stocks because, lease rates, et cetera, are very, very tight. And, this is kind of, in my view, this is kind of the paper markets, the paper silver market, like the paper gold market. people are saying, okay, give me the metal, right? And silver is one of those things. I mean, it's easy to move $1 billion of gold, or not easy, but it's doable. A couple 100 million of gold. Silver is goddamn heavy relative to its weight, and to put 15 or 30 million ounces on airplanes is going to cost a lot of money. And so I think it's on my Twitter feed. I think it's an interesting story to me that. And you're right, Mike. In the past, when these become front page news, you're near a peak. I think in this particular case, it's slightly different in that these metals are both very, very undervalued relative to total fiat money outstanding that competes for them out there. And so I personally believe we've got quite a ways to run, which is not to say there won't be pullbacks all along the way, but bull markets try and throw off all the riders. But as for me, I'm going to continue riding the silver and gold bull because I think we've got years of upward movement here. So that's just an overview.
Well, let's make it clear. The important part is the denominator, Larry.
Right.
That's the important part. It's not that it's
the book.
Gold and silver are expensive in $2020.
Yes.
$2025 when there's like double the number of them.
Right.
I'm not so sure how expensive it is.
Well, and in $20, $30, or $40, they might be downright cheap, right?
Yeah. So I think it's important. I mean, if you look at the market this morning, it's almost amusing, so, the S&P futures are indicating about recovery of about half of the losses of Friday, whereas gold is well beyond it, sniffing out what's happening. Silver, as we've said, is crazy. The long bond yield is looking like it's about to flirt with 4 again, but, it's still well within, the 4 in that very tight little range where it's been. But the important thing that needs to be discussed is what actually happened in the crypto market and what does it mean. And I know we're a macro show, but it's very important to understand the macro process here. So people need to understand that in global futures markets, other than perpetual swap markets, in most of them, there's very strict controls on what you can use as margin. And most traders use T-bills. They use something that is in the denominator as their margin for trading whatever they're going to trade. When in crypto, particularly on hyperliquid, and which was half of the liquidation, and on Binance, people are using multi-product margining. Which, what does that mean? That means they're using their volatile crypto to as margin against their leverage. So you could have a trader who thinks, well, 10 times leverage isn't that bad, because it means the market needs to drop 10%. Well, of course, obviously that's whatever. Or even 5-time leverage isn't that bad, because it would need to drop 20% for me to get wiped out. But if your collateral also drops 10% or so on the move, or looks to be dropping more, then it literally almost doubles. It's like a hinge, if you think about it. It basically doubles the amount of leverage that you actually have. And so trading firms in crypto, and I'm pretty sure we're going to find out that they were not with seasoned people sitting there who understand risk, get wiped out, as well as most individuals and small, basically crypto degen traders, because they don't understand how bad it can be. So here's the problem. If things start dropping and excess leverage is getting wiped out, and your collateral is dropping at the same time, particularly if it's really a liquid collateral, what the liquidation engines will do at the exchanges is they will be selling at any price. The problem is, and I wrote a paper about this, so it's on my Twitter feed, and we can find it, with a guy named Paul Rosa when I worked at 2 Sigma. The paper basically shows that in all electronic markets, liquidity is concentrated right near the bid and the offer. So what does that mean? That means once you punch through and start moving, in that instant, there's much less liquidity. Now, imagine it punched through, there's much less liquidity, and at that time is when forced selling happens from liquidation. Well, then it will continue to punch through. At the same time, the collateral value is valued by the liquidation engine at where it thinks it can sell, but there's no bids at that instant. So you things like there are a couple are obvious. I mean, everyone's talked about Cosmos. I was looking at BitTensor. BitTensor is one of my holdings. I've told before. BitTensor was at around 370, 380 before the event. it started falling, and before all the liquidations at BitTensor were done, it was down at 270. By the way, it's at 400 today. Just to give an idea of the flush. And then it's like people are like, well, wait a minute, I need to buy it back. I didn't really want to be out of it. And so you see that those sorts of things happening. The problem with all of this is it means if you use, and we talked about this with Luna when it happened, Scott, it's when you use illiquid collateral, very bad things happen. Because what it means is at the exact same time that your leverage is getting flushed, your collateral is getting flushed. And so
they also had automatic deleveraging. Hey, Ian's here. Many might recognize the last name, Ian Weisberger.
Yeah.
The issue is the automatic deleveraging that wipe people out on the short side and cause them to get unhedged.
Yep. And so all of that combined together to be a disaster. When you look at the aftermath, you look at Bitcoin. You know, you talked about Bitcoin having the biggest candle ever. Sure, I guess in dollar terms, but in percentage terms, it wasn't even in the top 50 probably of all Bitcoin candles, because Bitcoin, you know, collateral was reasonably well bid. Yes, it briefly dropped down to 100, which was at the time a 20% drop, but very briefly. I mean, it was within a 5-minute candle, but it was back up into 108 to 110 almost immediately. So all of this together shows you something about the mechanics of the market. Now, I don't want to have a mechanics talk. I want to do this in a longer form with somebody else, talking about the benefits and the costs of things like exchanges having circuit breakers and what does that mean and all the implications. The point here is the market itself is pure naked capitalism. It is pure free market. And unfortunately, in pure free markets, people who don't understand the things that they're trading do bad. So, like, since Ian is watching, I'll plug one thing about coin routes. It's interesting. People were whining about stop losses not working. Well, stop losses cannot work if they're market orders in a time when there's no bid. It just can't. But if you have a stop loss that's a little bit more intelligent and the market does what this does, you can do much, much better. So a smart stop loss.
But isn't this telling you, Dave, but isn't this telling you that we have effectively a fake order book? I won't say fake, but potentially the bulk of the bids are market makers. If you're firing, a coin can't go to zero if there's any actual bids. These coins went to zero. Here's the thing you need to understand.
This is true in every electronic market. It is true in equities. Very true in equities. It is very true in every electronic market that the bids and offers in the market are clustered very strongly near the price that it's trading at. And if you
there's no bids down 80%.
It's not fake. It's just the way it is. People's buying interest, people like to react to what they're seeing. That is the general nature. So there's a thing called an auction. And we all understand how auctions work. In equities now, you have single price auctions all day long and whatever. But in an auction, you don't get a price until people have a chance to respond. How many people would have put in bids if they had the ability to do so at Bitcoin at 102, 100, 105, and they just weren't fast enough? Many. How many people would have bought Cosmos at 50 cents? forget a penny. Or as I mentioned, BitTensor at 300. I mean, it's just.
I saw Sui went from like $3 to 50 cents to 250. And
right. So but the point is, this is not fake. This is the nature of electronic markets without any speed governor. It's essentially the Autobahn. Now, in a lot of markets, equities, they put in something, and I was an architect of this. I'm not proud of it because I don't like the way it ultimately came out, called limit up, limit down, which basically says it's over-engineered, as most things in equities always are. But it basically says if a stock moves too far, they halt it to let the buying and selling get back together again. Then in futures, they have circuit breakers at total futures, at index level things, and it's halts the market. Now, the problem with circuit breakers, and there's lots of problems. So the problem with circuit breakers it becomes a target when things go bad. Right? We've never hit the circuit breaker in the equity markets since they put them in, the total ones, for any length of time. But there is a circuit breaker where the market gets shut down for the day. And if Mike is right about a great unwinding and deleveraging and crash, like what happened in 87, you would hit those circuit breakers and the market would get closed down. In 87, the market, if the circuit had the same structure it does today, it would have shut, and it would have shut for the day sometime around 315, 320, thereabouts. So understand that that doesn't make it a better market, because now all of a sudden you can't trade, you can't hedge, and there's all sorts of reasons why that's not necessarily good. I'm not advocating for it, but to argue that crypto is faker than equities because it allows it to happen at 24/7. There have been plenty of times in the equity markets where if the market was open longer and there were no circuit breakers, that really bad things would happen. And a lot of after hours trading in equities looks very much like this. So I resent, I know I'm acting very defensive here, but I don't believe that those words make any sense. It is the nature of electronic markets when you allow for instantaneous trading to do that. That isn't a feature. It's not a bug. It's the way it's designed. And if you want it to be designed differently, then some exchange could design it differently. I mean, I could certainly help exchanges to figure out ways
on the
to
leverage
be
side, though. A lot of
safer.
these exchanges have insurance funds, right? So they basically step in as the bid. With the insurance fund hyper liquid and the decentralized exchanges, they don't. So that's why I think you saw such a
And that's
wild
why Ian's
wipeout
point.
on
And by the way,
DEXs.
we haven't talked, so I didn't know who was going to comment, but that's why Ian's point about automatically leveraging is important, because what does that mean? It means that there was a fear. The reason for automatically leveraging is because they think their insurance fund's going to is going to.
Dave, can I ask you a question? I don't really play in the space, because I just buy and hodl Bitcoin, so I don't trade it at all, and I don't play in the space. Is leverage of 2, 5, 10, 50, 100? Is that still available? I mean,
yes, yeah, but it's not that it's not the leverage that's the problem here. I mean, yes, it is. I mean, if someone's an idiot and they put 50x leverage and it moves 2%, they're wiped out. That's fine. The problem that I'm trying to say is, if you think you have 10 times leverage, which means you think you have time before a 10% move happens, but you actually have your collateral in the same asset. You actually have collateral in the same asset, then effectively you have double the amount of leverage than you think you do. And a lot of people were like that. A lot of people had big baskets of lots of assets that all moved together, and many of them went to crazy lows. Right,
yeah,
cross margin.
people got wiped on cross
which
margin.
is why some of the people who had the cryptos are getting margin called on their crypto position, and so they have to sell Bitcoin to come up with it.
Correct. And in fact, that's probably what happened.
Margin. Yes.
Because Bitcoin was less than a third of the liquidation, despite being obviously a larger percentage of the overall
Interesting. Huh. That's a good number.
So basically the amount of what's important is the Bitcoin was wiped was 5-something billion out of 16, but Bitcoin is around 60% of the non-stable coin, market cap. So Bitcoin was significant, and yet it had the candle that we talked about. We talked about it in Bitcoin terms. The Ethereum candle was much more violent. And a lot of these other altcoins, even the bigger ones, got killed. Now, the interesting thing is, if you look, the meme coins, the ones that Mike loves to bash on, and I actually agree with them. I mean, Fartcoin is still down.
Wants to buy lower. Mike just wants to buy lower.
Fartcoin is down over 30% from where it was trading before this.
How does Solana hold up? Did Solana hold up?
Solana's fine. Solana's at 190. It was
Solana, ETH, Bitcoin kind of had comparable levels of movement.
Yeah, they're fine.
Which shows I said persistent bid from non-crypto entities that will, keep those, I think, afloat.
Right. I mean, it's fascinating to look. I mean, as I said, I mentioned BitTensor already is actually higher than it was. Where were we?
BNB made new all-time high this morning before going down, by the way. There's a lot. So we're going to move on from this in a minute, but Binance faces intense backlash, obviously, over this. Binance covered 283 million in user losses already, and they admitted that effectively things broke down. Right. So yes, it's a free market, but Binance also said our systems didn't work that great. Right. And we know that happened on effectively every exchange. I also find it wild. And on the Bitcoin side, by the way, if you look at volumes, Larry, you were kind of asking about it. We had 2 larger volume days on Coinbase on Bitcoin in the summer with these kind of small candle spreads and dips being bought up. So this wasn't even the highest volume we've had in the last 3 months on Coinbase on Bitcoin. So this is very much a crypto thing,
Right. But the rest of crypto had extraordinary volumes.
Right. That's my point.
And obviously,
but I mean, it's also worth, and I'm sure Mike's going to comment on this. It's also worth pointing out that the stock market got shellacked. I mean, to me, the bigger, what all this means, it's a bigger issue, is just how fragile is this whole system that, a tweet by the president, and now he's claiming that he just misunderstood what, which is kind of
Wait, the
ridiculous.
market went down? I was wrong.
Yeah, and the market, just gets absolutely shellacked. I mean, I don't know, that it doesn't
Right,
strike me that
but
there are no signs of a healthy market here. I mean, I'm with Mike in that this is a very overvalued, very fragile market, and while it looks good to the casual observer, I think there's actually a great deal of risk in this market right now.
I mean, we won't call them stable coins, but we had DPEG. We had the entire library list of catchphrases you can have go wrong in the crypto market in one day. Like stable coins, Athena, depegging, and market makers obviously breaking down. They said the oracles weren't working. I don't believe, Larry, that this is all because Donald Trump said this at 5 p.m. on Friday. Right?
Oh, really?
Okay. Everybody loves to assign a narrative, but we didn't have a $19 billion liquidation because of a quick tariff threat.
Fair enough.
Right. Yeah. Go ahead, Mike. I'm sorry.
The key question now as we enter the beginning of 4Q, is this the beginning? Is this the end of just a little bit of liquidation, or is this the beginning? Obviously, my bias, it's the beginning. I'd like to show a few charts why. So first of all, Trump made those comments, but we know the number one thing that emboldens this president is the stock market, and that was proven by his 90-day delay back in April on the tariff. So what I show you here, this is 90-day volatility on the S&P 500. It just bottomed from the lowest level in 5 years. Wow. And the same chart is the 200-day moving average of the VIX. Those of us, our technicians, call that's a bull flag. It went up, it's staying there. Now the VIX is above that level right now, 19.3. So this is just little normalization. You get that 90-day volatility towards the same level as the VIX, which is about its average. VIX is usually trades at a premium. That's going to happen. It's just a question of when. I think it's happening now and sooner, and I'll point out some of the key things that really trigger me. Here's gold in terms of Bitcoin, the gold ounces. It's broken below this key support that's held since the bottom 2022. Now I show a weekly chart and also show the S&P 500 in terms of ounces of gold. It's breaking down. Looks like it's going to break below that low from 2020 at 1.5. And again, there's a good reason. Volatility is so low. When volatility gets this low, he just needs a little trigger. And Trump saying anything can be the trigger. So here's a key leading indicator, strategy. Those of us who invested in this thing in the past, it's broken down. Strategy is below its 200-day moving average. It's showing resistance and breaking down at the same time. Dave mentioned earlier T-bond prices. Again, this is where I started in the trading pits. What I thought I know the most, I thought had bottomed back here. It's just starting to show life to start rallying. That's deflationary forces as we get the deflation from cryptos. And I want to show you one thing that Scott's know I've been wrong on for quite a while. I'm just showing you this is the total return of the S&P 500 this year. Peaked up around 17. It's heading lower as volatility is bottoming. Now it's around 12%. And this is the total return of TLT, the most widely traded long bond contract in the world. I've been completely wrong in this. I think they're going to cross paths, and TLT is going to outperform the stock market this year. And one key reason is because volatility is just so low. There's so much speculative excesses, and cryptos are the leading top of that whole thing. And this is where I just look at this little chart from MicroStrategy. If it's going down, it's just a signal the whole space is just due for some mean reversion. What we saw this weekend is what you typically expect. So what do we do going forward? And that's why I think you're supposed to be looking to sell rallies in all risk assets. Even gold is pretty expensive at $4,000 an ounce, and silver above 50. It's not a place you want to go out and buy. Lessons have been taught by buying silver above 50. Sure, maybe it goes to 55, but you don't want to buy into when you have short covering or squeezes like this. This is when you're supposed to say thank you very much. And here's what I like to end with is it's really hard picking bubbles, shorting in the bubbles, using derivatives. Now I did that well in 2008, but because I had a rough year in 2007. What's been easy this year is being long gold, but now that's expensive. So what's the next big trade? And that's why I just look at that volatility. This volatility continues to just recover a little bit from a 5-year low. That's an awesome trade, but for buy and hold people, it's going to be tough.
Larry, in just 1 second, I want your thoughts on TLT, but Dave, I just want to show one thing because Mike and I did a show with Gareth Soloway on Thursday afternoon. And listen, Mike, we know that you've obviously been bearish and you've hinted towards it. This was the first time I ever heard you flat out say, I'm saying something I've never really said, sell everything. Which, for those who don't know, Mike was also, as he just said, saying sell gold, sell silver, sell the things he's been very bullish on throughout this entire time. And you said it very emphatically. Obviously, it's impeccable timing with what happened on Friday, but this is very high conviction for you.
Oh yeah,
Yeah,
but that's the key thing. When you keep saying the same thing, eventually you're right. But Dave knows it, Larry knows. I've been wrong on a lot of things, but it's the main macro that's just starting to kick in as we head towards fourth quarter. And it looks like the Bitcoin to gold ratio. Our model, my colleague Josh Daniel created a model, can easily go back to 15. It's 28 right now.
yeah.
So,
It's just thrown over the line barely, and I think it'll come back up through that line. But go ahead, Dave.
well, look, it's the denominator. I'm a broken record. I mean, so like your call on Thursday looked great. Gold is now $100 higher than it was back then. Silver is higher than it was back then. The stock market by the end of probably tomorrow or Wednesday will probably be higher than it was. I don't know about Bitcoin. We'll see. Crypto there was a lot of blood in the water. It's going to take some time for it for things to flush out, and we'll talk about it, the crypto specific stuff on Crypto Town Hall this morning. So I don't want to delve into a lot of what's going on there, but yeah, in terms of bankruptcies and people trying to figure out where the hell their positions are, etc. This was a big rock in a small pond, causing lots of ripples. But the thing about it is when we were sitting on Friday afternoon at 3:30. It looked exactly like the Friday before the stock market crash in 1987. It was exactly the same. It was a pinwheeling Friday. It had all the same vibes, the same sort of market action. And I tweeted at the time that there's going to be a lot of people over the weekend saying, oh my God, this is the same thing. We're going to come in Monday and there will be no bid and blah, 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 blah. Now, here's why at the time I didn't think it would happen, because there's no such thing as portfolio insurance, which is what caused the 87 crash and to spin out of control. And so people remembering things will get it wrong. But the truth is that if we do, in fact, do what I expect the market to do today, which is recover at least 50% and then see of what it lost on Friday, that the potential for an October panic seems to kind of not be there. Right, barring a black swan event like Xi and Trump deciding to punch each other or shots being fired or something, most likely that won't occur. The truth is that if you look at constant dollars to make decisions on the prices of assets, you're missing the fact that more dollars are being printed. There's a guy on this panel, I'm looking at him here, who kind of knows a little bit about the amount of dollars being printed, but it's a big deal. Now the government is shut. The one, I don't call it a black swan, the one thing that could actually help with the amount of printing is if the Democrats are dumb enough to continue filibustering for enough time. And I don't know what the exact rules are. We'll have lawyers could tell us, but there are some rules which basically will allow Trump to permanently close programs, lots of them. Will that help enough on our budget deficit? Probably not. Will people start thinking, oh, well, look, this is good, we're going to start getting the deficit under control? Yeah, people will think that narrative is there. Honestly, it's not going to happen. What's going to happen is they're going to fold. We're going to get a continuing resolution. They're going to talk about how much they need to add back for healthcare because the Republicans don't want to give them an issue for the midterms. And it will be business as usual in Operation Print. And that's the most likely scenario.
Operation Print.
And so we just have to understand that that's what you're looking at. And these markets are not tethered to a chart that doesn't divide by the number of dollars in circulation is going to get things wrong. And that's been my main point all to the entire time. And so, gold doesn't seem crazy to me. I still think gold's hit 5,000. I've been saying that for a while. I mean, yeah, pullbacks will happen, getting ahead of itself. Silver, the gold silver ratio could go to 50 easily. It's 15 in the Earth's crust. The reason for the gold outperformance, where 80 has been support, is because gold has been a monetary asset and central banks have been buying it, right? At some point, that starts to, kind of fade as Bitcoin gets into the picture, but it's not going to be now. It won't be this year. But could the gold silver ratio go down to 60 or 70 before it goes back up? Yeah, it could. It could. I mean, honestly, it will be probably under 20 in my lifetime if I stay in good health. Certainly in my son's lifetime, it should be that way because that's where it should be. And those are the sorts of relationships that are very long standing. But since we've had the gold backed money era, that's when the gold silver ratio has been between 80 and 100. And so those are a lot of cross currents, Scott. And if you're trying to trade this market, I mean, look, we just saw a candle in Bitcoin. It just jumped what, $1,000, which is nothing really. I mean, it looks big on the chart, but it really is nothing compared to what we are. The question really is, with all of these assets, is where's the value? And I will be happiest and say this rally that is likely to happen is more likely if the things that rally are the things that people really do want to buy and and less degenny of assets. So I think the Bitcoin fart coin ratio is really important, right? And I love to see that. I mean, you laugh, but I think it's a big deal, right? I think it really matters, and I think that's the sort of thing. But remember, money is being printed consistently in every major economy around the world. And so that's something that we have to understand. As far as interest rates are concerned, I mean, Bloomberg just told you that they think there's going to be 3 cuts. Remember, the newest member of the Fed thinks the risk-free rate is literally 3.5% below where we are today. And we're going to have a new Fed chair in May who likely believes the same thing. So what does that tell you about risk assets relative to historical norms? That's
I think the natural sort of, the next conversation, Larry, just going back to what Mike said, I know you have a probably opposing opinion on bonds and buying them.
Yeah.
And then I think we should kind of just set the table for what we believe comes next. Mike, obviously, kind of in the sell everything camp. Obviously, Mike thinking, Dave thinking, gold to 5,000, things continue up. I would be curious where you stand, have a conversation on that as well. But starting with bonds.
Well, yeah. So let me react to Mike's comments, and we'll come to bonds eventually. But so I think I disagree with Mike on sell gold and sell silver here. I think, and I understand from a trader's point of view, and it's way overbought, et cetera. It's moved, very rapidly for this past year. And so, yes, there'll be volatility, no question. And could they both correct significantly? They could. But I take a more multi-year point of view on these things. And I think we're going to $150, $200, $250 silver and $10,000 gold. I'm with Dave. The denominator is just going to keep growing. And what I think the mistake a lot of people are making is that they don't realize that the market is changing and we're kind of repricing what is money. And we're now we've gone from the gradually phase of fiat failing. I think we're kind of entering the suddenly phase. And that's based on what I observe in the acceleration of the gold price, and the silver price as well. And so, it depends on how you want to look at it. There are a lot of charts. In fact, there's going to be a lot of this. I'm writing my Q3 letter for my fund, which is free. It's on my website. It'll be out in about a week, less than a week, probably 4 days. And I've got all these ratios of the amount of gold and silver compared to the amount of the money supply. And we're still just scraping the bottom in terms of gold and silver repricing. I mean, if we were to go to 100% gold standard, full coverage of all dollars outstanding with the 261.5 million ounces of gold that the U.S. holds, we'd have to have a gold price of $90,000. So 90,000 is a long ways from 4,000. So I'm not suggesting we're going to go to 100% coverage. Generally, 20 to 40% gets it done. But my point is that, I think we're in the 3rd or 4th inning of a very significant gold repricing in fiat terms. And that's primarily because the government is completely and totally irresponsible. And, if that were to change, I would have to revise my views quickly. But I still don't see any evidence that that's changing. I mean, they're the big beautiful bill, and yes, tariffs brought in some more income, but the big beautiful bill ate all that up. And it's interesting to me what they just reported, the year-end deficit at 1.8 trillion, same as last year. It should have come in around closer to 2. If you read through the notes carefully, what you see is they changed the classification of some of the accounting to prevent it from coming in at 2.1, which
we don't define recessions the same either,
Lawrence. No, that's a shocker, right?
You
mean we can't trust the government numbers? Oh my God, I'm shocked, right?
If we get them.
Yeah. So, but it's all held together by the increasing stock market. So to me, what's going to happen in the gold and silver markets is kind of a pretty easy call, kind of a no-brainer almost. They're going to go higher over the next several years, undoubtedly. And then I think Bitcoin's going to do even better still. The chart that Mike showed, where the Bitcoin being right up against the increasing trend line, Bitcoin to gold, I think right now the easier trade is to buy Bitcoin than to buy gold. Gold's had a nice run. Bitcoin has lagged to that. Bitcoin will follow, in my opinion, and it'll follow with a vengeance. I think we'll be at 150 by year end and 250 sometime next year. So I'm quite bullish on both of these, both of these assets as against fiat. Where I'm a little less certain, and I've been dead ass wrong, and I don't know, Carl Asari and some other guys took me to task for it on Twitter, which kind of pissed me off. But I've always thought the stock market was a bubble and was going to be going lower, and I've been dead ass wrong on that. They've managed to keep the stock market inflated despite being at record high valuations by every single metric. And
nope, not every.
Close to them all, Dave. Close to them.
I mean, corporate profits are as bubbly as market cap. Market cap to GDP and corporate profits to GDP are the same chart. That's the difference.
Right, but they're both at record highs, as I recall.
They are absolutely 100%. But the point is that there are dynamics going in here. Some of that sloshing money is more money is moving into financialization of financial products than people want, and it's causing all sorts of interesting pathology.
And I mean, here we are, we're running these record deficits, and we've got a healthy stock market, so tax receipts from stocks are where they should be, according to the government. Well, what happens if and when that changes? Because we know in the last two big stock market declines, social costs go up, tax receipts go down, deficits blow out. We're running a record deficit percentage of GDP right now, or close to it, other than the two big prints. And we're starting to see cracks. Tricolor's a crack, First Brands is a crack. This Argentina thing is a big deal, right? I mean, we don't have money for lots of things, but we can print 20 billion pesos to, to keep Argentina out of China's hands. So, we're starting to see, and the data on consumer delinquencies in cars and consumer delinquencies on credit cards is getting worse. Not terrible yet, but there's some signs that maybe the economy is getting to be punk. I know Powell, for example, would have definitely liked to have been steady on rates or raised them so that he could maintain his Volcker reputation. Even he said, and he admitted, the risks to both sides were quite high and they hadn't attained their inflation mandate. But he said he was worried about the employment side, and that's why he cut 25 bips. So here we are. But I remain a raging bull on gold, silver, and Bitcoin. I think they're really the only way to protect yourself against what Dave describes as an increasing denominator, or I described in my book as the big print, which is kind of in the process of happening, but it hasn't gotten really big yet, but it might. So we'll see.
Yeah. Hey, Mike, the story that Lawrence mentioned, which is it's big enough that it really is a macro story, is First Brands and Jeffries. Any conversation about that in morning meeting, or people talking about what's going on there? Because no. I've heard multiple people saying, "Oh, is this going to be this Lehman moment?" I mean, I actually I spent a very small time in my career working at Jeffries. And a good friend of mine is in senior management there. I have not called or talked to him in ages, but I guess we used to be good friends. I just haven't talked to him in a while. But there are a lot of people, who are looking for the pin to prick a bubble. In my opinion, when everyone's looking for pins, chances are it won't happen. I prefer to think that bubbles happen when people are not looking for them, and it's really interesting. I mean, I want to see bearishness, if I'm long, right? It's that sort of thing. But the question is that it really is, Mike, chatter around your newsroom, or the people looking at any of these things as systemically risky.
So I want to tilt on that. Last week, I had the honor of presenting that and being part of Greenwich Economic Forum. And it was after that when I came out with that comment that sometimes you just have to sell everything. And I can't give investment advice, but sometimes just telling people to sell stuff that's appreciated too much. That was my take from meeting with some of the wealthiest people on the planet. And it's amazing. One thing I enjoyed, there was a crypto panel with 4 30-somethings on that panel. And every one of them was extraordinary bullish and had a lot of hubris and seemed to know everything about markets. And I looked around the audience, and the average age was 50 to 60, Greenwich types, New York types, who very wealthy, and just look at them like, yeah, I was 30 once too. And we all were. So it's just remember what's happening. I wanted to show you one chart of guilty as charged of trying to find peaks and bubbles, and that's why I want to point out, because we did speak out the 87 crash. Here I show you, this is S&P 500 divided by GDP in trillions, just not and divide by, take and make it take the trillions down to 100, so it's like 30 trillion right now. The peak for when right before the 87 crash was below 1 to 1. It was like 0.7. That held for 7 years. Okay, stock market cap to GDP. And this is my point now. Is you just look at pattern recognition. Here we are, the highest ever. Now it shows 2.1 because it's S&P 500 versus GDP. The actual stock market cap to GDP is 2.3. But I use this metric because I can go back 100 years. This defensible data on the terminal. Number one thing in life is defensible data. This pattern I see here would got volatility down really low, and this most and I would say entitled president ever is very scary. So what's going to happen, I just don't know from where, is we're going to go down maybe to this level, have a 50% correction, my call, and it's just a question of what sparks it. And so my thought was, beginning the year was, okay, still have the same view, it's overweight gold and bonds. Now the gold has done great. Shorting the market's a hard part. I did a lot of that in 2008, shorted the market, and you caught part of this, but you had to deal with this first. That's the key point, is right now we are so elevated. The only thing that matters, retail sales, everything, is the stock market. It's the the greatest wealth effect in history. And I do appreciate the thing is part of that wealth effect is cryptos. There's so many 30-somethings have made a lot of money. Some of them traded too much. It was the wrong thing to do, just buying and holding. At some point, you're supposed to say thank you and sell a good portion of that. Now, my rule when I traded, when I doubled, I'd sell half and then put the rest away. And that was a good problem because I love getting pissed off when things kept going up. But this is the point now. We're due for a reversion here. It's just a question what sparks it. And that's why I pointed out volatility so low, these kind of things. I look for the signals. It's the time of year. You're supposed to just sell rally. So my call for just sell everything, it's not a day trade. Yeah, it's nice it happened the day before, one little drop, but it's that S&P 500 total return on the year right now is 14%, yet bonds are catching up. I'm thinking maybe by the end of the year it might be 5 or actually down on the year. Now, if it's up, cryptos will be fine. If it's down, cryptos will lead the way. So Bitcoin will just fall on the back of all these millions of things that are just numbers on a screen.
So my thesis has always been that we are that the most bullish scenario for Bitcoin on a 2 to 3 year time horizon is a massive stock market wipeout, because that the response to the stock market wipeout will be money printing on a scale, that rivals where it was in the pandemic with this president and this Fed. I think that's fairly likely because they can't afford it and they need to juice asset prices. The trend toward financialization is coming towards its terminal point, but its terminal point, as is because you're getting closer and closer, you're going halfway each time. You don't actually get there for a while. It takes a lot longer than you think. But this entire complex, where the chart you showed is one of the scariest charts ever, it really is. And there's no question about it. But the question is, what's the denominator? How many dollars exist? And the pathologies that are happening, if you look at elections, so New York is likely to end up with arguably the most unqualified person to sit in the seat of mayor of New York that could even be proposed, right? You're talking about someone who doesn't believe in free markets in New York. You're talking about someone who wants to give free stuff to everybody because of the pathologies. And there's a lot of anger out there in younger people for a lot of very good reasons. If you listen to people, they will tell you, and the data on affordability of houses and things is rather extreme. And so what's happening is all this financialization, has a problem. And we talked about it last week. Housing is an asset. And if what you're doing is pushing inflation into assets, you're pricing people at the beginning of their lives out of those assets. And so it's not hard to understand how we're going to end up having a reckoning. I don't know when that reckoning will be. I think that I've said this before. I think that Treasury Secretary Bessent has the right idea. The only real chance to escape this is massive nominal growth, or as I like to say, grow baby grow, at the same time. Yeah, at the same time as so you need to deregulate and print at the same time to get out for our debt to try to get somewhere. But I just don't know if they're also going to be able to cut the waste that they think they can cut at the same time. It just, It's a very difficult situation. It's what they're trying to do. And as long as they're trying to do that, that's going to be a bid for assets that are performing. I mean, the entire stock market is very scary. There are the companies that are leading the stock market are priced to quote perfection. That's what most of us would call it. But if you look at their profits and you look what's going on in AI, I mean, it is a new industrial revolution in many respects. Some companies are going to do phenomenally well from a profit point of view, while labor is going to get trashed again. And that's going to cause all sorts of political backlash. So the likelihood of this being sustainable is not high. In 2025, however, I don't think those fault lines are really going to show. In 2026, they might. Next year could be extremely interesting as we approach the midterms, as we see how things are going. I mean, if there was a stock market crash between now and the midterms, unless it happened in the next couple of days, you would see. I mean, look, it's pretty obvious that what happened.
They're going to print so much money in May.
So let's just get to the next.
Really the issue, and that's what people are. That's why markets are where they are, though.
Yeah,
because with everyone expecting that.
Yeah.
And then you have to ask the question: is it enough? And that's my question.
The next 3 months. Well, we have, unfortunately, Dave, for our audience, they like when we disagree, we agree. I just want to point out the current situation in China is the big print. Their money supply running around 45 trillion by some measure, but on a terminal. I chat GBT'd it and said more than that. It's double the U.S. Their debt to GDP according to Goldman Sachs, is running 300%, yet PPI in China is minus about 3%, and the 10-year yield is 1.85%. That's turning Japanese. Those of us who remember trading JGBs 30 years ago, it did the same thing. And Japan's still finally coming out of it. They did the big print. It took them years to get out of that inflation, but it was because risk assets went down too much. Housing and the stock market. It's when you get the bubble that bursts, you can print as much as you want. You're still going to have those problems. And that's my point, is why I'm so concerned about cryptos and Bitcoin, is because they're risk on assets on the back of the stock market. If you get that normal drawdown, which we haven't, at least 20% and stay down for a while, you'll have the flush. You purge all the excesses. It'll be a great buying opportunity. But that's my point, is the big thing that's emboldened me to make the call I made recently is gold. I've just never seen this kind of rally. I look at S&P 500 is down 28% versus gold this year. Bitcoin's down, 20% versus gold this year. Well, that's just not the kind of thing. The last time these things happened was 2008, and Bitcoin didn't even exist. That's why I'm just very fearful, and I have to say what I think, because if I don't, it's disingenuous. I have to be able to help people when I see risks in markets.
That's a good point, Mike. And I think the risk of, when you've got a debt bubble that's as big as the debt bubble we've got, when it bursts, that's enormously deflationary. And 2930 showed you that. And you're right, they printed money back then and it didn't solve anything. And the price of gold actually didn't go up much during the 30s, but the purchasing power of gold went up 10x because the price of everything else fell massively. So, if we get into, one of the cases that I often consider is what happens if we have a deflationary bust and they print like crazy and the prices of gold and silver and everything go up a ton, but it's not enough to get the economy going again, and the economy is just kind of broken. And it's kind of a nasty world, to be frank. It's kind of a mess. But if you have to decide what assets you want to hold, I contend you still always want to hold assets that the government cannot print, because the problem is they've got too much debt and they have to reprice that debt in something that can't be printed. And there are really only two choices, and three: gold, silver, and Bitcoin. And so that is going to happen sometime in our lifetimes. But you're right, predicting exactly when, and is there a deflationary impulse before we get the massive big print? Probably. There certainly could be.
Larry, just quickly, you have obviously seen over the past 2 weeks, all of a sudden, the debasement trade narrative catching.
Yeah, isn't that amazing? Yeah.
JP Morgan, Paul Tudor Jones,
and
Griffin from Citadel, right? Obviously, the biggest names in the world, most of them have said Bitcoin, gold, some added silver. Paul Tudor Jones added NASDAQ. He thinks Bitcoin, gold, NASDAQ are your hedges against what you described. But you wrote the book. Like, what does it feel like to hear everybody screaming the debasement trade when you've got 3 copies of it right behind you? I got one right there. There's one copy. That's what that orange thing is.
Yeah, I even tweeted about this. I was experiencing a little bit of frustration because it's kind of like, I've been screaming this from the rooftops for 5 years, and now all these other people have caught on. That's nice. That's what you're supposed to do in investing. You're supposed to be right and then have other people come join you. But Muhammad Al-Arian was out there tweeting that he, like he invented the idea, and in 2017 he was shitting on Bitcoin. And this is what the elites will do. They'll eventually say, "Oh yeah, we knew this all along." And it's like, really? Well, were you buying Bitcoin at 4,000 like I was? No. It's frustrating to me because I can't really get, and I just want to spread the word. Okay. I don't care about selling books. I care about trying to spread the word so people get the message about how to protect themselves. And I can't get any elite media channels to pay any attention to me whatsoever, or publishers for that matter. And I suspect it's because I'm a pretty edgy guy, and I call them as I see them, and so I don't really fit their narrative very well. But
They will when it's too late.
maybe. But one other thing I find interesting on that, the mainstream is picking it up, and this really actually kind of really impacted me because I have a couple of the gym I work out at has a couple of Morgan Stanley brokers there, and they've been shitting on me for years. They don't believe any of my crap. Why don't you just buy the S&P? They've been telling them, and they drive Mercedes, they drive high-end Mercedes, and why don't you just buy the S&P 500? We've been telling our clients to buy the dip since 08. We've made them a fortune, Mag 7, blah, blah, blah. Well, guess what? Morgan Stanley very recently just came out and said they believe that their clients should have a 4% allocation. Now, they said crypto. Hopefully they meant Bitcoin. But I mean, that's a sea change. I mean, there was a time when, as a Morgan Stanley broker, you couldn't even recommend, well, you couldn't even sell it unsolicited. Then they say, well, if the client wants it, we'll sell it to them, an ETF. And then they got to the point where they could allow them to solicit and say, hey, you should think about this. And now their chief strategist is saying 4% is a good starting allocation. It's like, wow.
Not to interrupt, and to add to that, they announced spot Bitcoin and Ethereum and a few asset trading would come next year in Q2, and they just moved that up to this week.
Right. Oh, is that right? Yeah. So
yeah, I think October 17th.
The people are waking up to this debasement trade, and that's the other thing. There's really nobody in it. I mean, I've got this great chart in my quarterly that, it was a survey by Bank of America. It surveyed all money managers nationwide. I don't know if they got them all, but they got some big subset, probably representative. 42% have 0% allocation to gold. 20+% have under 2% allocation to gold. So, you're looking at a $160 trillion stock market. You're looking at a $27 trillion gold market. And it's really closer to 15 because a lot of that's antiquities and things that don't trade. And, basically 60% of the market, the equities in the US are not there. And so it doesn't take a lot of movement from those people. I mean, as an example, my fund is probably up 140% year to date. I haven't got my September numbers yet. The S&P 500 is up 14%. NASDAQ's up 18% year to date. How do all these algorithmic traders look at that and say, holy shit, we don't have any of the best performing asset class in the world, and they have to come after it. And that's why back to Mike's point, I'm very respectful of the fact that he's right. Generally, when you get this kind of excitement, you're near a top. But I would suggest that, there really is a sea change going on here, and nobody's been here. Nobody is in this space. And so as people come into this space, they're really going to, chase this stuff for some time. Now, there will come a top, Mike. I don't disagree with that, but I don't think we're there yet.
So let's just address those Morgan Stanley brokers by showing one chart. The S&P 500 total return. I go back to 1926. This is the total return. So you used to get dividends. It's the same as gold since 1997. So yeah, the brokers are making good money. I used to be a broker. I get it. I know what it is. But if you had just sat and bought gold at every dip or GLD or whatever ETFs, same return as S&P 500, and you got a lot less and you're not making brokers money. You're making yourself money. So that's the key thing. It looks like it's rolling over.
That's the thing. They don't make money selling gold, just like they don't make much money selling Bitcoin. They're in the stock selling business, and that's why they, have the narrative they have.
There's, it's the denominator, guys. It really
is. I
it's
agree with you, Dave.
That's the only thing that matters. And all I'll say is this, because I was just going on X and seeing the chatter. There are two massive forces that are in play right now at this point in time in our lives: AI and the denominator trade, or the debasement trade, whatever the hell you want to call it. Both of these matter. AI is going to drive corporate profits higher. Not all companies, that's for damn sure, but some will do extraordinarily well. There is an enormous change going on in terms of demand. I know of a lot of people. I was talking to people at conferences last week or the week before, and there are people like, oh, this AI stuff feels exactly like the internet bubble, global crossing, and all these kind of, you have to be old to remember this, but there were all these infrastructure companies laying cables and bringing up broadband. You just look at Cisco's market cap, you could bring that up. And they were saying, hey, the AI boom is the same as that. We're going to massively have overcapacity. We are
use all that fiber.
Except for
and to be fair, they were early, but that fiber all got used
eventually, but it took 20
Correct,
years.
but the companies that built it went bankrupt.
Right.
Correct.
But here's the thing. Right
It's early,
now,
but they were right.
the supply demand dynamics are totally different. Right. The amount of compute that is needed for the big companies is more than double what is being produced, which was not true with with what was going on in fiber. It was like, oh, well, this demand's going to come. It's going to come. It's very different from the demand is here and we can't satisfy it. Those are very different scenarios. Now, does that mean that the entire market's going to do well? No, it doesn't. It means the people who are producing the stuff that's in demand is going to do well. But here's the problem with this. It's going to be a lot like Peloton. Peloton in the pandemic, everyone was buying Pelotons, right? So the stock went like crazy and they thought it was sustainable. Now what happened? People got let out of their houses. It's like, oh, damn, my Peloton's a coat rack. I don't need it. And all of a sudden you can sell it. At some point when all the models are trained to the point where all the old data is there will be, this demand will go up. It will peter out a bit. I mean, will it crash like Peloton did? Probably not. But it's going to get ahead of itself. It just isn't there now. And there's lots of really, I've listened to multiple podcasters who actually been digging into this. It's different. So while that's happening, I think the stock market is in good shape. It's not the same thing as the Bitcoin or gold trade. I think the Bitcoin and gold trade is simple. We have double the number of dollars. Gold needs to be double the amount of price, and more people are less confident. The fact that, understand what happens. The entire world was blithely ignorant about this notion of what is a dollar. People looked at Larry as a lunatic, and and now
Still do.
Welcome to the party, Larry.
World, now all of a sudden in the mainstream, we're starting to get into cognitive bias. People understanding that there's more dollars and there's more euros and there's more yen and there's more whatever. It doesn't really matter which other ones you go to. Everything but Swiss francs, who they devalue just to keep themselves afloat because they don't want their currency to be that strong. They like to be able to export stuff. That trade penetrating the public consciousness is not priced into any of these markets. That's why I think gold goes well beyond, I don't think these levels are high, actually. Even 5,000, I don't think is high, although I do think the market will have a hell of a time getting through that. And we'll probably have a major correction between now and then, but I think it gets there. That's why I said the same thing. But Bitcoin, if the people who are buying Bitcoin as a percentage of Bitcoin holders today is much more tilted in the direction that I'm talking about. Most of the new money going into Bitcoin are people playing the debasement trade. That's just a fact. That's where the ETFs are coming from. Those are people who look more like us buying into Bitcoin.
Check this out. Just in, total spot Bitcoin ETFs trading volume surpasses 1 billion in the first 10 minutes of trading today.
Right. So that is happening at the same time as the entire crypto complex just got wrapped on the knuckles multiple times by, a nun with a massive ruler, some people getting it much worse. So the degen control over the market is getting less and less. That doesn't mean that it's changing immediately, but as a percentage is definitely changing. And that ultimately will allow Bitcoin to start making the transition. It will, at some point, if Larry and I are right, transition from risk to be more like gold and less like the NASDAQ. And maybe that NASDAQ, because of the AI revolution for a couple of years, if Paul Tudor Jones is right, that NASDAQ is trading more like Bitcoin and gold, than the other way around. But the truth is that the narratives are very, very different. And the narrative in Bitcoin and gold is a pure narrative. Right?
Yeah. And I tweeted something about this and there was some confusion. The new retail is not getting rinsed on hyperliquid using leverage. This is the same crypto natives gaining, losing, and going player versus player against each other. The new retail woke up today and was like, Bitcoin's pretty cheap. And they bought a bunch of Bitcoin ETFs, and they didn't know that after hours on Friday that we had a leverage flush across exchanges because they don't watch Binance charts and they've never heard of Hyperliquid. And so the buyer of last resort, or the base buyer at this point, is a very different kind of retail than the retail we've talked about in crypto for all of these years. They're just different people. They're normal people who want that 2 to 4% Morgan Stanley exposure and saw that Bitcoin's 114 when they woke up instead of 125.
I mean,
As a final, yeah, go ahead.
It is. I'll tell you what's amazing. I'm looking at the Wall Street Journal under markets and finance right now, which used to be the old C1 for those who are old and remember what the hell that means.
I do.
And we have first brands, we have, energy stocks, China tariffs, first JP Morgan investing in companies, former bankers betting on flood insurance, biotech's rally, behind the collapse of an auto parts giant. Nothing, not a whisper on the front page or even anywhere of the largest liquidation event in the history of crypto. That makes the chart. And do you have the liquidation chart up? If you look at the liquidation chart, it's now a meaningless. It is literally an impossible chart to read. So if you look at total liquidations on coinglass.com, the chart that shows the days, the bar is so big that the rest of the chart is unreadable because it's the scale.
Well, yeah,
just scroll down. Yeah, scroll down. Look at that.
Yeah.
It is so large, it made the rest of the chart unreadable. And
these used to be big bars, really big bars.
Yeah, exactly. And so this was big. I mean, it was in a one day, it dwarfed anything even that happened in the FTX, saga and all that. Now there,
12 times,
wave after wave after wave of forced selling in a market that had no other buyers. Here we had this massive flush that was so much bigger, and the broad market doesn't care. Think about that. What is that telling you? It's telling you
it's a different market. It's completely bifurcated. It's a completely different market.
That's right. And that matters. And that does matter. So, a lot of people are looking at this in the crypto side and saying, okay, what the hell happened? And we'll, as I said on Crypto Town Hall, we'll get into the details. But the truth is that from a Bitcoin buyer perspective, part of what could have happened this morning was panic. People say, oh my God, the volatility is much higher than I thought, and dumping, and they didn't. Now, will they? Who knows? I mean, God, I don't have my crystal balls in the shop, but it certainly doesn't look like it. And, and all the technical analysts who are saying that this breaks it and, et cetera, that's just not going to be true. Now, Tom Lee is reassuring people, but Ethereum's chart looks more or less the same. I mean, where did it go down to 3,700? Thereabouts? I don't know.
Yeah, I think so. It depends on this is one of those days where exchanges could have a 10%
right. And Frank, and it's one of the reasons why the single largest volume day in the history of coin routes was over this weekend. So yeah, for that reason, for those who don't know or haven't heard me talk about it, it's software that allows our clients to trade intelligently, knowing what's going on all exchanges at the same time, among other things.
By the way, Tom Lee bought 485 million in ETH on the correction. Greg Cardone added 300 Bitcoin. Michael Saylor, of course, he would have bought regardless. But nobody's the big names aren't flinching at this, and they're not stopping. I know that we got to go momentarily. I just want to say that it's very interesting to me that no matter who we have come on these shows, the end game is always agreed upon. It's just the path that we have arguments about, or which asset to own. I mean, even if you got Peter Schiff on here and you could get him to emotionally stop talking about Bitcoin, I literally had an interview and I said, Peter, we're not going to talk about Bitcoin. We're going to talk about all the things we agree on. And he railed about Bitcoin for an hour. Like, he just can't stop himself. but if you got him on and you said, hey, what do you think the future is with money printing and debasement? We would all agree on all the same things. It's just everybody disagrees on which asset to own to protect against it down the road. Yeah. It's very interesting because the brightest minds, everyone we talk to, they all agree that eventually there's going to be a very, very big fire, right? Yeah. So really interesting. Larry, thank you for joining today.
Fun to be with you.
Awesome. And guys, I'll be back tomorrow. Dave and I will be on Crypto Town Hall in 8 minutes. That promises to be relatively explosive. We'll dig into this a lot more. And of course, we'll be back next Monday. I think James will be back, but Larry, you're welcome anytime. Oh, and he has 3 copies of his book back there. I tell you, I have one literally on my shelf. It's the only book there. you guys read the big print. Seriously.
Thanks, Scott. Appreciate
Seriously.
that.
And not just
Good to see
because now Ken Griffin said to. Do it because we said it. All right, guys, that's all we got. We will see
Take
you
care.
tomorrow. Thanks. Bye. Are you looking to earn up to 9% APY on your cash backed by real cash flow assets? Or want to secure a crypto-backed loan at 8.91% interest rate? With the Figure Markets app, you can do both, all in one mobile app. They've released the first ever real-world asset borrow-lend pool called Democratized Prime. It allows you to earn up to 9% by lending your money against real-world assets like home equity lines of credit, known as HELOCs, which only banks were able to do prior. Lend like a bank and get more than what others are offering to you on your stables. Figure is also the largest non-bank mortgage lender in the US with over $17 billion unlocked on their lending platform. Access loans starting at 8.91% interest rate, the lowest fixed interest rate in the industry at 50% LTV, all with decentralized custody, which allows you to see a segregated personal Bitcoin wallet with your Bitcoin in it on chain. Download the Figure Markets app today with my personal link, figuremarkets.co/Scott Melker, and start earning 9% on your idle cash, or take out a Bitcoin-backed loan at industry low rates.